Welcome to the deep dive. Today we're digging into the fundamentals of stock investing using a really interesting source. Paul Mladjenovic, Stock Investing for Dummies, the second edition from back in 2006.
Yeah, 2006. It's quite a lens to look through, promising to be a plain English guide with savvy tips.
Exactly. And the author, Paul Mladjenovic, he's a certified financial planner, writer, speaker, clearly knows his stuff.
Yeah.
The goal here is really to pull out those core ideas, the basics that stand the test of time.
And revisiting these foundational guides is always useful, I think, seeing what was emphasized then.
Totally. And I love the foolish assumptions part right at the start. He basically says, look, maybe you're a total beginner. Maybe you're already investing but have gaps. Maybe you're just reviewing things.
Or maybe someone gave you the book.
Right. He even
class.
says that. It just makes it feel really accessible. Like wherever you're coming from, this is supposed to help.
That's key for a topic like investing, which, let's face it, can feel pretty intimidating for a lot of people.
For sure. And a book's laid out pretty clearly, too. We're going to focus mostly on part one, the essentials of stock investing. Mladjenovic says this part is for everyone, even if you kind of already interact with stocks through, say, mutual funds or your pension.
Building that solid foundation first makes sense.
Okay, so let's jump into one of those first big ideas. Market capitalization, or market cap. What exactly is that in simple terms?
Well, market cap is essentially the market's total current valuation of a company's stock. Simple calculation, really.
How does that work?
You just take the current price of one share of the company's stock and multiply it by the total number of shares that are actually out there, the ones investors own.
Okay, so share price times number of shares. Got it. And it gives you a sense of the company's overall size.
Exactly. It's a quick shorthand for how big the market thinks the company is, value-wise.
And the book breaks this down into different sizes, different categories, right? Which
Right.
I found pretty helpful.
Yeah, he outlines four main ones. It helps you sort of frame the landscape. First up, you've got the micro caps.
Micro, tiny ones.
Pretty much. These are companies with a market cap under $250 million. They're the smallest, often the riskiest.
Risky, but potential for big growth, maybe?
That's the trade-off, yeah.
Yeah.
Huge growth potential because they're often new or in niche markets, but also, higher chance things could go wrong. Their stock prices can swing wildly. Definitely for investors who can stomach more risk.
Okay, so micro caps, what's the next step up?
That would be small cap. These are companies valued between $250 million and about $1 billion.
Still focused on growth potential.
Generally, yes.
Yeah.
Still seen as having more room to grow than the really big guys. But like microcaps, they carry, well, significant risk. Maybe less established, more vulnerable to economic bumps.
Right. Then we get into the middle ground.
Yep, mid-cap companies, typically falling somewhere between, say, $1 billion and $10 billion in market cap.
And what's the story there? Sort of a balance.
Often, yeah. People see them as kind of a sweet spot. They might offer a mix of growth potential, maybe more than large caps, but with a bit more stability perhaps than the small caps. They've likely proven their business model to some extent.
Okay, that makes sense. And the last category, the big players.
Exactly. Large cap. These are the giants. Market cap over $10 billion.
Your household names, probably.
Often, yeah. Think major banks, big tech, established consumer brands. They're generally considered the least risky category.
Less risky, but maybe slower growth potential compared to the smaller guys.
That's usually the expectation. More stability, often pay dividends, but maybe not the explosive growth you might find further down the cap scale. Understanding these categories just helps you think about risk and potential reward.
Okay, super helpful breakdown. So we understand company size. Now, Mladjenovic really hammers home the point that before you even think about buying a stock, you need to know where you stand financially.
Oh, absolutely fundamental. You wouldn't start a road trip without knowing where you are on the map, right?
Yeah.
Same idea. He stresses creating a personal balance sheet.
Right, the balance sheet. That's a snapshot of what you own versus what you owe.
Precisely. At a specific moment in time, on one side, you list all your assets, anything of value you own.
Like savings, investments, maybe your car, jewelry even. The book mentions personal stuff.
Yeah, cash, bank accounts, stocks, bonds, retirement funds, real estate, even valuable personal property.
Yeah.
That's the own side.
And the O side, liabilities.
Correct. Liabilities are all your debts, credit card balances, student loans, car loans, mortgages, any money you owe to others.
And the difference is your net worth, assets minus liabilities.
That's it. Assets minus liabilities equals your net worth. It's a crucial number to know your financial baseline.
But that's just one point in time, isn't it? He
Right.
also talks about tracking the flow, income, and expenses.
Right, because the balance sheet is static. To see the movement, you need an income statement. This tracks your total income.
Salary, interest, maybe side hustle money.
Exactly. All sources of income over a period, usually a year. And then you track your total expenses, or outgo, as the book puts it.
Rent, mortgage, taxes, food, utilities, insurance, car payments, fun stuff. Basically everything you spend money on.
Yep, all of it. Payroll taxes, living expenses, transportation, recreation, the works.
And looking at income versus outgo tells you your cash flow.
Exactly. It helps you create a cash flow statement, which is just a summary of money coming in and money going out. Critically, it shows you if you actually have surplus cash each month or year.
Surplus cash that you could potentially invest.
That's the idea. You need to know realistically how much you can afford to put towards stocks without messing up your budget or emergency savings.
Makes total sense. And all this groundwork, balance sheet, income statement, cash flow, it's all leading towards setting financial goals, right? He really connects investing back to that.
Absolutely. Investing shouldn't just be for the sake of it. It's a tool to reach your specific financial goals.
Like retirement, buying a house, kids' education.
Whatever your big goals are. Knowing those goals helps define your timeline, how much risk you might be comfortable taking, and ultimately what kind of stocks might fit your plan.
Okay, so financial house in order, goals defined. Now, how do you actually approach picking stocks? He talks about different strategies. Let's start with investing for income. What's that about?
Investing for income is all about focusing on stocks that pay dividends.
Dividends. That's like the company sharing its profits with the owners, the shareholders.
Exactly. It's a portion of the company's profits paid out, usually quarterly, to people who own the stock. It's different from interest you get from a bond or a bank account, because as a stockholder, you're an owner, not a creditor.
And investors looking for income pay close attention to the dividend yield, correct?
Yes, the yield is key. You calculate it by taking the total dividend paid per share over a year and dividing it by the current price of one share.
So annual dividend per share divided by price per share gives you a percentage.
Right. It tells you the annual return you're getting just from dividends relative to the stock's price. But a word of caution the book implies. Don't just chase the highest yield.
Why not?
Sometimes a super high yield can be a warning sign. It might mean the stock price has fallen a lot because the company's struggling, which artificially pumps up the yield percentage. You want dividends from healthy, consistently profitable companies.
Good point. Okay, so that's income. What about the flip side? Investing for growth.
Investing for growth focuses on companies you expect to increase significantly in value over time. Capital appreciation is the main goal.
So the stock price going up is the focus, not necessarily dividends.
Correct. These companies often reinvest most or all of their profits back into the business for research, expansion, new products, rather than paying them out as dividends. The idea is that this reinvestment will fuel faster growth and hopefully a higher stock price down the road.
So potentially higher returns, but maybe less immediate cash flow from dividends?
Generally, yes.
Yeah.
Different objective.
And then he talks about investing style, like conservative versus aggressive. How does that fit in?
This is more about your personal risk tolerance. Conservative investing prioritizes, well, safety. Protecting your initial investment is key.
So you look for it.
Probably more established, stable companies. Large caps, maybe? Companies with long histories of steady earnings, perhaps reliable dividend payers. The potential returns might be lower, but the perceived risk is also lower.
Okay. And aggressive investing.
That's for people willing to take on more risk for the chance of higher returns.
So maybe those small caps or micro caps we talked about, or companies in newer, faster growing industries.
Exactly. Aggressive investors are generally more comfortable with volatility. They might invest in younger companies or sectors with high growth potential, fully understanding that there's also a greater chance of losing money.
It really comes down to knowing yourself as an investor.
It does. Your goals, your timeline, how much uncertainty you can handle.
Now, we've touched on risk a few times, but Mladjenovic dedicates a whole chapter to it. He starts with a really basic principle, right? The risk-return trade-off.
Absolutely fundamental. You can't escape it.
Yeah.
Generally speaking, the higher the potential return an investment offers, the higher the risk you have to accept.
And conversely, lower risk usually means lower potential returns.
That's the classic trade-off. No free lunch, as they say.
He then breaks down different types of risk investors face. What's the first one? Financial risk.
Financial risk is the most basic one. The risk that the company you invested in just doesn't do well. Its business falters, profits drop, competition heats up.
Or worst case, it goes bankrupt.
Right. In which case, your stock could become worthless. That's the core risk of owning a piece of a specific business.
Okay. Then there's interest rate risk. How do interest rates affect stocks? That seems more like a bond thing.
Well, they're connected. When overall interest rates in the economy go up, borrowing becomes more expensive for companies, which can hurt their profits.
Ah,
Also, when rates rise, safer investments like bonds or CDs suddenly offer better returns than they did before. That can make them look more attractive compared to stocks, potentially pulling money out of the stock market and pushing stock prices down.
and falling rates can help stocks.
Generally, yes. Lower borrowing costs for companies, and stocks might look more appealing relative to bonds. It's complex, but rates definitely matter.
What about market risk? Just the whole market going up or down?
Exactly. That's the risk that the entire market takes a dive, a bear market, or enjoys a big rally, a bull market.
Hmm.
Individual stocks, even good ones, tend to get pulled along with the overall market tide. It's also called systematic risk.
You can't really diversify away market risk, can you?
Not entirely, no. It affects almost everything.
Okay. He also mentions inflation risk.
Yeah, that's the risk that the money your investments make doesn't keep up with the rising costs of living. If inflation is 3% and your investments only return 2%, you're actually losing purchasing power. Your real return is negative.
A silent wealth killer.
It can be, yeah,
Yeah.
especially over long periods.
Then there are risks from outside the market, like tax risk, governance stuff.
Right. Tax risk is simply the chance that governments change the tax laws in a way that negatively affects your investment returns, like changing capital gains taxes or dividend taxes.
And political or governmental risk.
That's broader. It covers things like new regulations affecting an industry, political instability, trade wars, government policy shifts, things that can impact
Yeah.
specific companies or the whole economy.
He also brings up personal risks, which I thought was important. It's not just about the market.
Very true. This is about your life circumstances, losing your job, having a big medical bill, some other emergency. These things might force you to sell your stocks at a really bad time, locking in losses just because you suddenly need the cash.
A good argument for having an emergency fund separate from your investment.
Absolutely essential. We'll get to that.
And finally, emotional risk. Letting feelings mess things up.
Oh, this is a big one. It's the risk of making bad decisions driven by fear, like panic selling during a downturn, or greed, like piling into a hot stock without doing your homework.
He uses the dot-com bubble example, right? People just throwing money at internet stocks in the late 90s.
Yeah, a classic case. Euphoria took over, fundamentals got ignored by many, and then, well, the bubble burst spectacularly in the early 2000s. Lots of people got burned by emotional investing.
So, okay, lots of risks out there. How does Mladjenovic suggest we try to minimize them? It's not about eliminating risk entirely, is it?
No, you can't eliminate it, but you can manage it. First and
Okay.
foremost, knowledge. Understand what you're investing in, do your research. Don't just buy based on a tip or hype.
Makes sense. What else?
He strongly advises having savings outside the market. That emergency fund we just mentioned. Cash, safe, liquid assets to cover unexpected expenses so you aren't forced to sell stocks at the wrong time.
Get your financial house in order first.
Exactly. Manage your debt. High-interest debt especially can counteract any investment gains you might make.
And the big one, diversification. Don't put all your eggs in one basket.
The absolute cornerstone of risk management. Spread your money across different companies, different industries or sectors, maybe even different types of assets beyond stocks.
He specifically warns against putting everything in just one stock, right? Or even just one industry.
Yes, strongly. He suggests owning stocks in at least 4 or 5 different sectors to avoid being overly exposed if one particular industry hits a rough patch.
And finally, it comes back to matching risk with your goals.
Right. Weigh the potential risk against the potential return for any investment, and make sure it aligns with your specific financial goal, your time frame, how long you plan to invest, and your personal comfort level with risk, your investor profile.
Someone near retirement probably shouldn't be taking the same risks as someone in their 20s.
Generally not, no. Time horizon is a huge factor in how much risk you can reasonably afford to take.
Okay, so we've covered understanding risk and managing it. Now, how do we get a sense of what the overall market is doing? He talks about indexes, like getting a snapshot.
Yeah, market indexes are super useful tools for that. They're basically benchmarks, statistical measures that track a specific group of stocks.
A group chosen to represent
Well,
a sector? The whole market.
could be either. Some track a specific industry, like technology. Others try to capture a broad segment of the market or even the entire U.S. stock market. They give you a quick way to see the general trend.
He starts with probably the most famous one, the Dow Jones Industrial Average, the DJIA.
The Dow, yeah. It's been around forever. Tracks 30 large, well-known U.S. companies, often called blue chips. Historically very important.
But it has limitations.
It does. It's only 30 companies, which is a tiny slice of the whole market. And it's price-weighted, which is a bit unusual.
What does price-weighted mean?
It means stocks with higher actual dollar prices per share have a bigger impact on the index's movement, regardless of the overall size of the company. A $200 stock moves the Dow more than a $50 stock, even if the $50 stock company is much larger overall. Most other major indexes aren't weighted like that.
So it can be a bit misleading sometimes?
Some argue it can be, yeah. And its components change over time. Mladjenovic mentions GE being in it forever until 2018, and companies like AT&T and Kodak being swapped out earlier. It evolves.
Okay. Then there are the NASDAQ indexes, often linked with tech stocks.
That's the common association, yes. The NASDAQ exchange lists a lot of tech companies. The NASDAQ composite is very broad, includes over 5,000 companies listed on the NASDAQ.
Ah, 5,000, that's broad.
Very. Then there's the NASDAQ 100, which is more focused. It tracks the 100 largest non-financial companies on the NASDAQ. Because they often include many high-growth tech stocks, these indexes tend to be more volatile than the Dow.
Swings up and down more.
Can do, yeah. Reflects the nature of many of the underlying companies.
What about the S&P 500? That one seems to get quoted all the time.
The Standard & Poor's 500 is probably the most widely used benchmark for the overall U.S. stock market. It includes 500 of the largest U.S. companies across many different industries.
So it's seen as more representative than the Dow's 30 stocks.
Much more representative, yes, because it's broader and it's market cap weighted, meaning bigger companies have a bigger influence, which most people feel reflects the market better than price weighting.
Okay. He also mentions even broader indexes like the Russell 3000 and the Wilshire 5000.
Right. These aim for even wider coverage. The Russell 3000 tracks the 3,000 largest U.S. stocks, covering about 98% of the investable U.S. market.
Practically the whole thing.
Almost. And the Wilshire Total Market Index, often called the Wilshire 5000, even though it holds more than 5,000 stocks now, tries to capture basically all U.S. publicly traded stocks. It's the broadest U.S. index.
So different levels of zoom, from 30 stocks up to almost everything.
Exactly.
And it's not just about the U.S., is it? He mentions international indexes, too.
Crucial point, especially today. Indexes like the Nikkei in Japan, the FTSE 100 or FTSE in the UK, the CAC 40 in France, the DAX in Germany, the Hang Seng in China, they track major markets around the world.
Useful for seeing global trends and for diversifying.
Both, absolutely. If you want to invest internationally, these indexes help you understand those markets and benchmark performance.
So, practically speaking, how does an average investor use these indexes?
Two main ways. First, as a benchmark, you can compare how your portfolio of stocks is doing against a relevant index, like the S&P 500. Are you beating the market, matching it, lagging it?
Okay, a performance yardstick.
Right. Second, you can actually invest in the indexes themselves indirectly.
How does that work?
Through index mutual funds or, increasingly popular, exchange-traded funds ETFs.
Index funds and ETFs, yeah.
These funds are designed to simply hold all the stocks in a specific index, like the S&P 500, in the same proportions as the index. So when you buy a share of that fund or ETF, you instantly own a tiny piece of all 500 companies.
Ah, instant diversification.
Exactly. It's a very common and often low-cost way to get broad market exposure. ETFs have the added advantage of trading like regular stocks on an exchange throughout the day.
So you can buy and sell them easily.
Very easily. Makes index investing very accessible.
Well, this has been really illuminating, a proper deep dive into those core ideas from Stock Investing for Dummies. We've really covered a lot of ground.
We have market cap, getting your financial house in order, different ways to invest, like for income or growth.
Understanding all those different kinds of risk, which is huge, and then how to actually track the market using indexes.
And I think Mladjenovic's goal, even back in 2006, was to show that this isn't magic. It's about learning these fundamentals. It's really a starting point for, lifelong learning about investing.
Building that foundation is key, like you said earlier. It lets you navigate things more confidently.
Definitely.
So, thinking about this constantly changing financial world, how can understanding these basics really empower you, the listener, to make better, more informed choices? And maybe think about which specific area we talked about today really sparked your curiosity the most. What do you want to dig into next? That's maybe something to reflect on as we wrap up this deep dive. Thanks for joining us.